Hello and welcome to MF Corner. I'm Sonal Bhutra in the Mumbai studio, and today on the show we are going to be discussing all the queries that you have sent to us on email, social media platforms and otherwise as well. To answer all your queries, let's welcome Nasir Salim, the managing partner at Flexi Capital, to answer all of them. Nasir, good afternoon. Thank you so much for joining in. And these are very individual queries, so it's going to be very helpful for the viewers as well. So let's not waste any time and get going. Prasad is writing to us from New Delhi. He asks if we can make lump sum investments considering the volatility that we're seeing in the markets. He asks what are the good flexi cap funds. He adds many experts have a bias and they would end up suggesting funds like Quant or JM Flexi funds, but he thinks there are some management issues there. So he asks what should he do in that case. Nasir?
Good afternoon, Sonal. Thank you very much for having me on your show. To Mr. Prasad's question, clearly the current market conditions and the significant run-up in valuations over the past one and a half years, a systematic transfer plan would be a more prudent approach to entering the fresh investments. Clearly, in terms of fund selection, what we need to do in this case is, remove advisor bias. And in this case, the way to do this is you need to look at certain very important metrics and parameters, such as alpha, standard deviation, information ratio, AUM size, for example, and certain qualitative parameters. So my recommendation to Mr. Prasad is that he needs to look at funds which, with these metrics, can be shortlisted. And what will then come out is the advisor bias moves away, whether it's a JM or a Quant, any other asset management or any other particular fund that is being recommended. If you have these metrics available and if you evaluate them against every metric, the output will throw a very different result, for example. In our case, when we looked at, if I'm looking at your current question on flexi funds, we feel that the funds from HDFC and ICICI, for example, have consistently emerged as a top quartile performer in its category. And it demonstrates a very strong risk-adjusted return, making it a suitable option for those looking for diversified equity exposure, and especially in your case.
Okay, all right. So those are the two names you recommend from the flexi cap space for Prasad. Prasad, I hope that answers your query very clearly as well. The next one is coming in from Roshan Sharma, who's writing to us from Mumbai. He says the upper circuit filter limit for Nippon Hang Seng ETF was set at 0.38%, while for the Mirae Asset Hang Seng Tech ETF, the circuit limit was 20%. This is as per last week. He wants to know the rules of both upper circuit and lower circuit filter limits specifically for ETFs, because now it's confusing him and there's so much action in these ETFs.
Sure. So, clearly, before I get into the specifics of the filter limits, let's understand this in 30 seconds. The circuit filter limits are basically mechanisms that are implemented by stock exchanges to control excessive volatility during trading. So, that's the main purpose. And these limits get applied on securities, including ETFs, and which are designed to prevent any extreme price movements driven by panic buying or selling. And that may happen because of the current volatility that we're experiencing. And they're done basically to destabilize the market, right? From any of those sudden buying and selling, panic selling. So circuit limits are not uniform across all securities or ETFs. To answer your question, they are based on several factors, such as liquidity, volatility. So, for example, a more liquid ETF may have tighter circuit limits as they are traded more frequently, and tend to have lower volatility. Similarly, volatility ETFs with higher volatility, such as sector-specific or niche market funds, may have wider circuit limits to account for larger price swings. So, clearly there are no set limits, but this is a function of the stock exchange sets these limits based on liquidity and volatility in that particular ETF. Or ETFs.
Okay, all right. So that is what happens with ETFs. Higher volatility may have wider circle limits and vice versa. Moving on to the next one, RM Krishnan is writing to us from Madhya Pradesh, wants to know how he can utilize retirement corpus by the systematic withdrawal plan route. He asks will the SWP be more tax efficient? How can he go about it?
Before I answer this question, Sonal, clearly you should consult a tax expert for better guidance. But what we will tell you is that the route adopted for systematic withdrawal plan, the redemptions are basically made on a monthly basis to meet regular income requirements, such as during retirement or for a specific target corpus that you're looking at amassing. The rate of withdrawal is typically set slightly lower than the fund's expected return. So, for example, if a fund is supposed to give you, say, gross of 8% per annum, the expectation can be of liquidity withdrawal every month can be, say, somewhat, say, 6%, hypothetically, allowing for a buffer to ensure sustainability over time in times of volatility, which we're experiencing even now. So each month, a portion of the principal units is redeemed, Sonal, along with any profit that are generated. Now, here's the very important point. This approach basically minimizes the amount of profit being booked on a monthly basis, which in turn reduces the taxable income. I think this is very, very important, as a result of which there could be a possible lower tax liability on the amount received each month. And when you speak to your chartered accountant and qualified CEO on this, he will be able to explain to you how beautifully the SW process works, which is far more efficient. Overall, SWP provides a very structured and a steady flow of income. So in addition to steady and structured flow of income, it also maintains a very good balance between capital preservation and tax efficiency, is what we have witnessed in the last 2 years.
Okay, all right. So it provides a balance between capital preservation and there's tax efficiency as well. So one can go about it if they want to save taxes. But as you said, always good to go ahead and look at your individual investments as well. Let's talk about the next one now. Rahul Khanna is writing to us from Chandigarh. He says he's invested in 2 flexi-cap funds, which an SIP of around 18,000 rupees. He's investing 10,000 rupees in a Nifty mid-cap fund, an SIP of 26,000 in a small-cap fund, and another 6,000 SIP in a Nifty 50 fund. He wants you to review the allocation if it is right. You want to make some changes here. Wants a detailed answer here, Nasir. What would you suggest?
Yeah, so again, I think, look, the approach has to be very, very balanced again. It has to be across large, mid, and small. And we're assuming the assumption here is that the horizon is beyond 5 years, 5 to 10 years, and that's where he's looking at, creating this wealth. So first and foremost, if you look at some of the funds that it is prudent to invest for the longer run, it should be a mix of 75% in large cap, and these can change. These can change somewhat, but broadly, what we are suggesting or shortlisting is 75% in large caps, 25% in mid and small caps combined, right? Given the current volatility we are in. However, there is flexibility to increase the allocation to mid cap funds slightly because you have a longer time horizon. I think in the current market conditions, particularly crucial to have a high allocation to quality large cap and flexi cap funds, as these allow fund managers the flexibility to dynamically adjust the allocations across small and mid caps as needed, including large. And the approach that that would ensure that you benefit from the stability and strength of large cap stocks will also ensure growth opportunities across various companies, quality companies. So a structured strategy ensures a diversified portfolio. What we are saying clearly is a good balance approach, 75% in large caps, and the balance 25 between quality mid and some small caps may be a right possible option for you to choose. Right.
It's always good to have every kind of fund, not a lot of them, of course, but a balanced approach, as you said, is very important. Moving on to the next query now, Shruti Mishra is writing to us from Noida. She wants to know what are some of the mutual funds to invest in if the market corrects further. I know there is no amount given here, Nasir. There is no risk awareness as to what is the risk for the investor or the long-term goals as well. But generally, if there is a direct answer for this, what would you suggest?
So here again, I think the disclaimer very clearly is that we're assuming that Shruti Mishra is basically an aggressive investor and has a horizon of beyond 5 years, clearly. And she will not look at any drawdowns between now and the next 5 years. So given currently where we are, and this is more with respect to the current market conditions in time, we would recommend a combination of core and satellite funds that should be diversified in the portfolio. When we look at core portfolios are basically, fundamentally strong companies that the funds have invested. And those funds are captured, those including index funds. So for the core investors, can consider index funds for broad market exposures, large caps. We like some of the good large cap fund names there between Nippon and ICICI, for example. Some of the flexi cap funds are also very, very interesting. So core will again consist of some flexi cap funds, where in this case we like HDFC and again ICICI because they're known for their consistent top quality performance. Then we look at something called satellite. Now, this is, you need to seek guidance from an expert, Sonal and Shruti. It's very, very clear that the satellite portfolios keep changing, right? Depending on market timing and sectors and cycles that play out. Currently, we feel that the consumption theme broadly looks very interesting to be captured, and that can be done through good quality consumption sectoral funds which are available. We're looking at them because it's driven by robust demand, and that will support this satellite portfolio. We're also we feel that the banking and financial services as a shortlisted sector is also looking very, very interesting. So clients may look at that sector as well Shruti may look at that as well to diversify. And a ratio ideally between 60 to 70% in core and about 30 to 40% in satellite will ensure that your portfolio is well diversified, it is stable, which will and capturing opportunities for hiring. And this structure allows you for strategic participation in market recovery while managing risks in a volatile environment.
That makes a lot of sense that you have a split between your core or your satellite portfolio that would help you diversify your risk as well as your money as well. Nasir, we have a lot more queries lined up for you, but we have to get into a quick commercial break. On the other side, we'll continue to answer all your mutual fund queries. Stay tuned. Welcome back. You're still tuned into MF Corner. We have with us Nasir Salim of Flexi Capital. We are answering all your individual mutual fund queries. We have answered a lot of them, Nasir, and there are still few to go. So let's get started. Radhika Srivastav writes to us from Mumbai. She wants to know whether momentum funds are good only in bull markets or are they all-season funds? We've seen momentum funds doing really well. A lot of NFOs in the momentum space as well, Nasir. Do you think that could continue considering the volatility?
So Sonal, the strategy of momentum funds can be boiled down clearly to investments in securities that have upward trending presence, which you rightly said. And of course, in a broad-based bull market, momentum funds generally tend to outperform, as most securities with a higher beta tend to outperform, right? Which we've seen in the last few quarters, and we've been seeing that for the last 12 to 18 months. However, when the market tends to start shifting towards a flat or a bearish market, momentum funds naturally tend to do worse than quality and low volatility funds. I think that is something which investors in mutual funds need to know and be cognizant of. Momentum funds are not all season funds. Clearly, they're not all season funds. And investors should seek guidance from experts. And when it's being, any fund that is coming, being recommended to them or being shortlisted, you must question this. That if this is a momentum fund, and why is it being recommended? And of course, they are not all season funds. They need to seek guidance from experts on when and where in the cycle they should invest in these funds. Okay.
As you said, it's cyclical, and in volatile times especially, it's best to go to an expert and ask for momentum funds. And surprising to see a lot of NFOs in this as well, a lot of interest generally, despite the kind of market that we are in. But let's move on. Neeraj Dama writes to us from New Delhi. He has invested in a Nifty 50 fund and PPF and wants to know whether he can invest in an SIP of 25,000 monthly. I do remember the concern also was whether he's lagging the market returns. What do you suggest, Nasir? Now is the time to start that SIP?
Absolutely. I think, clearly we're assuming that the investor here is moderate as from a risk profile perspective, and looking at a PPF is a safe investment. Usually the comparison is drawn, or the parallel is drawn with a risk-free return. And historically, if you look at PPF, for example, they've given 7.1% historically. And Nifty 50 index fund is a passive equity investment, which is also considered the most optimal way to invest in markets for passive investors who do not wish to actively check in on the markets. I think overall the equity exposure from the index fund, along with the safe PPF investment, is suitable for a passive investor and with moderate risk-taking ability, and especially during these times of market volatility. I think one of the very important things that I want to say on your show, Sonal, is, and to investors like them, is there are many people who haven't experienced a market correction in the last 4 years. And I think, under an asset allocation model, understanding the risks that you're taking on every unit of capital that you're investing in does warrant. And I think allocation like this with a Nifty 50 fund and a PPF is a good, suitable option for passive investors.
passive investors, definitely that is the way to look at. And as you rightly mentioned, a lot of the investors haven't seen any market correction. It's been a one-way rally for them. So it's very important to be cautious and to take expert advice whenever you can with your investments. Moving on now, Arindam Bhattacharjee is writing to us from Kolkata. He says he has started an SIP in HDFC Nifty 50 index fund in the name of his children, and the amount gets debited from his account. He asks if during the time of withdrawal, does he need to change the bank account details to their kid's name, or he could still withdraw from his account?
So we're going with the assumption that this is being done for his children, obviously, and until the age of majority. The child achieves the age of majority. And it is suggested to update the bank account to your children's name, which is also a requirement as per the law of the land in terms of KYC and compliance, that the children's name is to ensure smooth processing and compliance with the regulations. So assuming the child has attained the age of majority, which is 18, the child's KYC has to be done, and the withdrawal can then take place from the child's bank account. And that's the right way of doing this as well.
Okay, all right. So this is the way you can go about when it comes to changing the names and some of the compliance, rules when it comes to investing for your child. Moving on, Munish Mittal is writing to us from Mumbai. He says he has been investing in mutual funds like Mirae Asset Large Cap and Mid Cap Fund, HDFC Mid Cap Opportunities, HDFC Flexi Cap Fund, and Nippon India Large Cap Fund. He asks if his portfolio needs any adjustment. So it's a full portfolio that Munish has spoken about here, Nasser, and he's given the amounts as well. It's a huge portfolio that will come up for you on the screen as well, but these are the large ones. So if you can just take a look at this, advise him as to how to go about it.
So, my first thought when I'm looking at the screen now is, an overexposure. Basically, if you have a lot of funds in your portfolio, that leaves the investor in an over-diversified position. I mean, that is something which the investor here needs to really give a little detail to. There are repeating exposures with most. See, a lot of times we keep adding in because of market, cycles. And I said, there's somebody who comes and tells you, you read about it, pick it up and start investing. After a few years, you realize that there is a lot of multiple funds that are in your portfolio. However, the asset allocation for the aggregate portfolio, in this case, which I'm seeing in the screen, is fair, with heavy allocation to larger and more conservative, and small allocation to riskier bets. It would be prudent, in my opinion, to prune down some funds that have repeating exposure. So that's an overlap. I think that is something which can be reduced. And a large cap exposure through 5 funds and mid cap exposure through 4 funds should be good enough. I mean, you don't need to go beyond that, right? Ideally. The funds can then be divided into my original point, which I spoke to for another investor query, which is between core and satellite. With the core portfolio including all long-term uniform investments, and the satellite portfolio including shorter-term speculative thematic sectoral calls, which you need to keep changing and evaluating with your, the person you're seeking guidance from. And that is something which you need to be very, very important. Overexposure is not required at this stage. A good quality large, good quality flexi, good quality mid-cap funds will get you, and a good quality small, depending on how it is diversified, will get you home. So a large portfolio is avoidable. 15, 16 funds is something which leaves an investor over-diversified is what I feel. And you should prune down your holdings to the quality 2 to 3 large cap funds, 2 to 3 good quality flexi cap, and 2 to 3 good quality mid cap, and maybe 1 to 2 small caps. That's it. So not more than 6 to 8 funds at max.
Not more than 6 to 8 funds at max. And you're very helpfully given us a table as well where you can divide it between core and satellite 50-50%, where you have an SIP of 28,500 in each. In one of the cases, it would be 40-60 and the other would be less as well. So where core in a sense would have 45,600 and satellite would have 11,400. So that makes sense. Thank you for specifying that for us. Last query for the show. Nitesh is writing to us from Chennai. He asks if there's a commodity or precious metal mutual fund that he could invest in currently. Also asks, do commodity mutual funds perform better than equities?
So clearly there are many opportunities available in the precious metal asset class. Some of the precious metal asset classes perform quite well, right? With gold returning approximately 33% in the last 1 year. Now, precious metals are often perceived to be safer investments than equity. You should make up a portion of your overall portfolio. And however, I must tell you this, that it is imperative that the risks associated with precious metals should be kept in mind when investors investing. precious metals provide much required diversification. Sonal, I can tell you that. Currently, both gold and silver, for example, are available from few asset management companies that you can invest in. Commodity MFs do not perform necessarily, right? Better or worse than equity mutual funds. However, they provide a different risk-adjusted return profile and should be considered by any rational investor looking to diversify their portfolio. I think specifically commodity mutual funds are viewed as an effective hedge against inflation. Therefore, in times of high market volatility, which is currently, Sonal, commodity mutual funds tend to outperform equity mutual funds, given if you're in volatile times. I think some of the funds that, if is in particular the question is, there is something which is available from the Edelweiss stable, both which captures gold and silver. We have Nippon, which covers the Nippon India Gold Savings Fund. If I remember correctly, there's also something from the Kotak Gold Fund, which can be considered very favorably. So there are available opportunities within the commodity space that can be considered and that may be shortlisted.
All right, that's very helpful, Nasir. Thank you so much for patiently answering all those queries. We have a lot more, but completely out of time on this edition of MF Corner. Thank you for joining in today, and stay tuned for Closing Bell to take you through the last hour of trade.